I don't think it's a good idea to be charitable just to receive the tax benefits. But if you're already charitable and you are contributing to charity, I think it's perfectly within reason to want to make sure that you minimize the amount of tax owed. I think it's a good idea to make sure that we revisit opportunities that are available to taxpayers. If you're currently giving to charity, why not do so in the most tax efficient way possible? That's what the purpose of the video today is. If you've not yet met, my name is Danny Sinowitz. I'm a CFP professional from Hyperion Financial. Let's cover 4 strategies that I think could be applicable to retirees who are charitably inclined and want to minimize the amount of tax owed. The first one is what's known as a qualified charitable distribution, otherwise known as a QCD. QCDs are available to taxpayers who are 70 and a half or older and currently have pre-tax retirement accounts, specifically IRAs. What you're able to do is you're able to take a distribution from your pre-tax IRA and have it directed to a charity, and any distribution that you take would be considered tax-free, assuming you follow some of the rules. Now, those 5 rules that you want to make sure that you're following. Number 1 is that it's an IRA, not any other type of account. If you're sending this from a 401k or a 403b, it's not applicable. It needs to be done from an IRA, an individual retirement. The second rule is that you're sending this directly to a 501c3. It needs to be a nonprofit charity, but specifically needs to be a 501c3 in order for the QCD to qualify. The third thing that you want to make sure of is that you're taking this distribution and having it go directly to the charity. You cannot take possession of the funds. In other words, I can't take a distribution, have it deposited into my checking account, and then I send the distribution to the charity. I need to have it go directly from my IRA to the qualified charity. The fourth thing that you need to make sure that you're doing is sticking true to the annual limits. And the last rule that you want to make sure that you follow is that you meet the age requirement. And many folks assume that this can be done with your R&D, and that is a correct assumption. However, you're eligible to complete a QCD as early as you're age 70 and a half. So if you're 70 and a half, or at least 70 and a half, and are charitably inclined, you may want to consider the possibility of a QCD. Something you want to be aware of, though, with the QCD is that it doesn't automatically show up on the 1099 at the end of the year. So you want to make sure if you're completing this, especially with a tax preparer who may not be aware, a QCD that would be done internally, it will not necessarily show up on the 1099. Instead, you need to make sure that you communicate this with your tax preparer and that you have a paper trail to make sure that you're not finding yourself in a position where you can't justify or show that you've done this move. But there are plenty of benefits that you can take advantage of with a QCD. A distribution from a pre-tax IRA would be considered a taxable distribution in almost every scenario. But if you complete a QCD and have it directed towards a charity, you avoid income tax altogether. And there's no secret about all the benefits that you can have if that distribution is instead sent to a charity rather than you taking possession of that and recognizing it as income. One of the second things that I think is important to understand is going to start to take effect in the tax year 2026. And it comes as a result of the tax bill that was passed on July 4th of 2025, otherwise known as the One Big Beautiful Bill, that now allows for 2 things that I think are going to be important for both itemizers and for those that are taking the standard deduction. When it comes to charitable contributions, what you have previously been able to do is itemize your deductions and include charitable contributions along with it. However, with the passing of the Tax Cuts and Jobs Act of 2017, the standard deduction was raised so significantly that about 90% of taxpayers did not itemize their deductions. As a result, for several years, there was no reason to actually consider itemizing deductions or, at that point, keeping track of your charitable contributions. There is a change for itemizers when it comes to your charitable contributions. There is now a floor of 0.5% of AGI for itemized deductions, specifically when it comes to charitable contribution. So for example, if you have an AGI of $200,000 and you contribute $1,500 to charity, there's a floor of 0.5%. So $1,000 would basically conduct that floor, meaning only $500 would be eligible to be itemized on your return. So make sure that you're aware of this if you're currently itemizing your deductions and are charitably inclined. One thing, though, that I do think is going to change for the 90% who utilize the standard deduction is the introduction of a charitable deduction beyond the standard deduction. So this is something that you can take advantage of up to $1,000 as a single filer or $2,000 as a married filing jointly filer. So if you are contributing to charity and utilize the standard deduction, you can deduct an additional $1,000 or $2,000 depending on your filing status and take advantage of this. So starting in 2026, it's a good idea to make sure you keep those receipts that you would have had when it comes to your charitable contribution. Now, this isn't necessarily a large amount, but it's enough to make sure that if you are contributing to charity, that you consider writing off. Something you want to take advantage of, and there's no reason not to if you're claiming the standard deduction and are not taking advantage of other charitable contributions to begin with. The next example is what's known as a donor advised fund. And I think donor advised funds could be a great planning tool to take advantage of itemized deductions and the gain that you can do in a year. I'm going to go through an example and show you 3 different scenarios and the tax savings that can really add up. But the concept of this is actually bunching your charitable contributions by making a one-time large contribution to a donor advised fund. From there, that donor advised fund is strictly meant to be given to charity. You can no longer take that and utilize that for your own benefit. Once you make the contribution, it goes towards charity, and that's that. However, some of the big things that can be taken advantage of with that is you can invest it accordingly. You can then make grants and distributions to different charities over the course of the lifetime that you have the donor advised fund. There's no requirement that you need to take it out in any one given year, or nor any distribution amount that you have to make in any given year. You're able to direct it to charities of your choice. So by doing this, you can again take advantage of a one-time contribution up front. And I'll show you in just a second what the contribution can mean from a tax standpoint, but you're then able to direct it to charities accordingly. Let's see what this would look like for somebody who experienced a pretty sizable payout in a given year and what a donor advised fund can offer. So what we're looking at here is the tax year 2024 versus 2025 projections. And what we find is that this individual had a sizable payout from a business opportunity that took place. And what we're looking to do now is to see if we can make a contribution to a donor advised fund to lower the amount of taxable liability that this taxpayer would take on. So this taxpayer and he and his wife informed us that they made contributions to charities throughout the year, about $10,000 to $15,000 per year. So by making a one-time contribution to a donor advised fund, they can lower their tax in the given tax year, but also then have several years in which they can make distributions from the donor advised fund and potentially have this spread out either over their lifetime or for a very significant time here in the future. So due to the fact that this taxpayer had a sizable payout, the wages went from $135,000 to an additional $400,000 that they would have had in a payout. That $400,000 brings the wages up significantly, pushes them to the highest tax bracket. So you can see here the wages, tax exempt interest, etc. This really does add to the bottom line of the individual's tax bracket. You can see also here there are long-term capital gains that are going to be recognized along with some Schedule C income. The total income that we're seeing down here is over $600,000. Now what we can end up doing here is we can end up taking advantage of itemized deductions, in which case a contribution to a donor advised fund would significantly decrease the amount of tax that would be owed. So let's say that in the middle column here with the $100,000 DAF, we make a $100,000 contribution to a donor advised fund. That being the case, we can see that the taxable income is decreased by about $100,000. If we get really aggressive and do a $225,000 contribution, that then brings the income down to $390,000. In either scenario, we're lowering the income quite a bit. And as a result, we're lowering the tax quite a bit. So in a normal year, they would owe $142,000 of tax. If we make a $100,000 contribution, we're lowering it by over $20,000. By making a $225,000 contribution, cutting back about $60,000 of tax that is owed. The beauty of this is that you can lower your taxes in the given year, but moving forward, distributions that you take from the donor advised fund that are directed towards charity are completely tax-free. Additionally, any growth that takes place is also tax-free. So it's a great way in which you can front load charitable contributions and then have it distributed over time to different charities. And you want to be aware that you need to complete this by December 31 of the tax year in which you're looking to set the donor advised fund up. So as a result, a contribution that we made to a donor advised fund can be done, but it needs to be done in the calendar year. The fourth strategy to consider is donating appreciated assets. And this is one that I think has a double benefit as opposed to just a singular benefit. When you talk about appreciated assets, we're not talking about assets that are within a 401k, IRA, or something that would be tax deferred. Instead, we're talking about something in a non-qualified account or an after-tax account. So for example, if you have Apple stock and you purchase that with after-tax savings, that Apple stock has grown significantly over time. So your cost basis may be low. Let's say it's $5,000, but it's grown to $100,000. In a normal scenario, if you sold that stock and you've done so and it has a long-term capital gains tax treatment, you would recognize $95,000 of long-term capital gain in the year in which you complete the sale. But when it comes to donating appreciated assets, this works a little bit differently. If you donate the stock to charity, you avoid capital gains tax on the appreciation. So therefore, you don't have to worry about paying any capital gains tax. You also get a charitable deduction for the full amount that you've contributed. So by you picking a very good investment and doing so over time, the charity certainly will make out because they get the full value of the stock, but you also make out in that you don't have to pay any type of long-term gain, but you also get to deduct the full value of the actual stock. So in the example that I used, you get to deduct $100,000, not just the $5,000 of basis. Again, let's cover the rules on this one. Let's make sure we're doing this properly. The first one is that you contributed this with an after-tax source. As I mentioned, it needs to be a non-qualified account. This would not count if it was done within an IRA, 401k, Roth IRA, etc. It needs to be done with an after-tax source. The second thing is to make sure that you actually donate the stock itself. You cannot sell, realize this in cash, have it liquidated, and then make the contribution. You need to make sure that you give the actual stock itself. That way, you can avoid any type of long-term capital gains treatment. In order to deduct the fair market value as well, you also need to make sure you've held this for at least over a year. If you hold it for under a year, you can only deduct the cost basis, not the growth along with it. And once again, the charity must be recognized as a 501c3, or it can also be recognized as a donor-advised fund. The tax benefits of this one can also be pretty significant because, again, when you make this contribution, you're able to make sure that you avoid any type of capital gains treatment, specifically if you hold it for over a year, but also making sure that you're able to deduct the full value of this. So if you're not planning to utilize this and instead you want to take advantage of the tax benefits and have your favorite charity or one of your favorite charities actually appreciate this, this is something that can be done in a very favorable way. So depending on your situation, one or maybe all four or some combination of them could make sense for you. Regardless, if you're contributing to charity, it's a good idea to continue doing so, and don't do so just for the tax benefits. But if you're interested in saving on taxes and you're already contributing to charity, why not take advantage of the tax savings that come along with it? As I mentioned to you, one of the big changes within the Big Beautiful Bill is the fact that you're able to now take advantage of this in 2026 and moving forward. If you're interested in learning about more that's changed in the One Big Beautiful Bill, check out this video right